All right, here we are. We're back. It's Mike and Glenn. We want to talk about on this episode. We want to talk about something that we all love to talk about, and that is the equity that we're building in our home. So we want to talk about some options. And today's topic, Mike, let's talk about the HELOC or home equity line of credit.
Yeah, right. We hear in the news, right? Home values are at their highest point ever. But what does that actually do for you, right? If you're not looking to sell or buy a property, right? That equity is typically sitting in your property. And now there's a couple of ways to access that. But let's go into, right? Like, why would you want to access those funds? What would be the reason that you would want to use your home equity?
Maybe I want to maybe I want to do an upgrade to my home, or I want to do an addition onto my home. Maybe I want to pay off some debt. Things are very expensive today, and we're all adding credit card debt. So maybe we want to consolidate some debt with all this equity and save some money overall. So a couple good options there to be able to pull some money out of your
Yeah,
home.
and I would say, right, whether it's investments, right? Some people are
Mhm.
taking money out of their property to whether it's purchase their next home, their dream home, and keep their existing property, whether it's to purchase an investment property or you need money to invest in a business or things like that. Really just trying to put that equity to use without putting yourself at risk, right? There's a lot of limitations on how much money you can access, but sometimes that money can be best used not sitting in the property.
So yeah, something like you bring up a great point, like a very low interest rate on my current first mortgage right now. Pull the equity that I've got in my home. I keep that loan, that first mortgage in place. I have this second mortgage or this line of credit, and then I use the rent that I'm going to get from this home to be able to make the mortgage payment, and then I've moved on to my dream home.
Yeah, I mean that's a great way to utilize it. Or right, maybe your home just doesn't suit you, right? You don't want to move to that next house, but maybe you want to redo a kitchen, maybe you want to add a bedroom, right? Or maybe you want to make the house that you're in your dream home. Well, a lot of people utilize a home equity line of credit to be able to do those renovations on the home while keeping your payments low.
Yeah, so a couple options that you have is you have, before we talk about the equity line of credit, you can always do a cash out refinance on your home and just keep one mortgage on the property, and we pull that equity out that way. Depending on what we're doing there, sometimes that might not make sense because hey, you've got this great interest rate on the first mortgage. So the other option is to do a second mortgage or a what we call a HELOC or a home equity line of credit. Or then there's also another one that you can do, which is a second mortgage, which we call a HE loan. And Mike, maybe we kind of differentiate between the two of those. So let's start off with maybe the HE loan or the loan, and then talk about the pros and cons to that.
Yeah, and I think this is where a lot of questions come on and not the understanding of truly what are your options. So, a home equity loan is similar to your first mortgage, right? You pull out a certain amount of money. Let's call it $100,000. Now, that's a loan. So, that's a closed end loan, meaning that when you close on that transaction, you're going to get that $100,000 and you're going to start making payments on that. Now, typically that's going to be a higher interest rate than a line of credit. And typically you're going to pay principal and interest on that second mortgage. But a lot of people, they don't need all the funds today. So the drawback, right, is that you are pulling all that money out at a time and it's fixed payments. So you may see that higher payment when looking at a home equity loan versus, go ahead.
No, I was going to say benefit to that is just, hey, I'm setting my budget. I know what my expenses are this month. I know what my expenses are a year from now.
Yeah, and you can set a clear plan of, hey, I only need this much. I'm not going to take more, and I want to pay it off in a set period of time. A lot of times, a home equity loan, right? You might see a 15 or a 20-year term, so it'll be a shorter period of time that you are paying back that
And
mortgage.
maybe that's a pro, maybe that's a con, right? Like that could be a benefit. Hey, because shorter term on the loan, we're paying that equity back a lot quicker, or we're making that equity available to us much quicker. Downside of that is, hey, that payment is going to be more expensive.
Yeah, that's correct. And from
So
a
go ahead,
go
Mike.
ahead.
Your turn now.
No, I was going to say from a consolidation standpoint, right? That may not be what you're looking for in terms of higher payment. Maybe it's flexibility that you need in today's challenging market, right? That's depending on how your income comes in, right? A lot of people need more flexibility, more cash flow in today's environment. And that's why you look at a line of credit. So this is a home equity line of credit. Think of it like a credit card on your house. Not necessarily that you want to max out your credit card, but the way that it operates. Meaning that let's take that same $100,000. This is a open-ended line of or open-ended loan where you don't have to access those funds immediately. Take out that $100,000 on a property, and you have what's called a draw period. So this is a 30-year loan on the line of credit, but it has a 10-year draw period, meaning that you have access to those funds during that first 10 years of this mortgage. So again, let's say you took out $100,000, but let's say you never took any money to start. Well, over those first 10 years, maybe you in a year from now, right? It's more of a rainy day fund that, hey, I'm going to redo my kitchen in a year. Well, now you can pull and you're only responsible for making a payment on what that draw is that you take, what that balance is.
So wait, so on this line of credit, so difference here from what Mike, what you're saying is difference here is that on that home equity loan that we were just talking about, I take out that 100,000 and I pay that money back, or let's say I pay $20,000 of that back. I don't get access to that $20,000. I just owe $30,000 on that loan at that point. So you can't really access that equity anymore. Where what Mike is saying on this equity line of credit, you have this $100,000, you take out 50, you pay down 20,000, that 20,000 becomes available to you again so that you can reuse it. So you can reuse it during this draw period that Mike's talking about to let this balance go up, pay this balance down, and you have access to those funds, rainy day fund, investments, improvements, consolidation of debts, whatever you might like to do.
And that's important to touch on in terms of how it operates during that first 10 years is that you are only required to make an interest only payment during those first 10 years. So again, you have 100,000, let's say you only took out 50,000. Well, you're going to pay interest only on that 50,000. If you pay it down, you're only going to pay interest only on that remaining balance. So your flexibility is definitely there, but the safety net is there. If you needed that full $100,000, you have access to it at any point. Versus, like you said, that home equity loan, you pay it down, right? That loan is still whatever the balance is. You don't have access to go back to it. And that's home ownership, right? You may have a project in year 3, pay it off. You may have a project in year 7 and work to pay it off. So that's the flexibility that it gives you.
I mean, you may have a life event. I've always talked about these as, hey, there's a life event that happens where you need access to those funds. Well, if you don't have this equity line of credit set up, you don't have access to these funds. Maybe you don't qualify for, depending on what that life event is, but you're not able to get to this. So you have it sitting there and you're using part of it for improvements. You have this rainy day fund there for you and you can use it that way. So Mike, let's just earmark this real quick as we're talking, or let's tag this real quick as we're talking. This is the beginning of November. Interest rates on first mortgages are somewhere in the high 7s, 8%. The equity loan, Mike, what are we looking at on that? And then what are we looking at on like an equity line of credit?
Yeah, so an equity loan, you're probably in that 12, 13, 14% range, depending on the provider that's offering it, versus a line of credit, depending on credit scores, how much equity you're utilizing in your property, right? All these factors that impact that rate. You can see it anywhere from the prime rate, which is kind of around 8%, to that point of 10, 11% on there. And a lot of people kind of cringe at the sound of those rates, but we have to keep in mind, right, that again, you're only paying interest on the amount you borrow. And we have to keep in mind, well, what is the interest rate on the debt we may be consolidating, right? Maybe it's 15, maybe it's 20. Credit cards at 30% is very common right now. So we have to really best structure it. Do we want to consolidate a car loan at 2%? Maybe not, right? Like, and that's where working with someone that understands your goals to best position those funds.
Exactly. And that's the point that I was wanting you to make, is that a 10% interest rate, you're like, whoa, like 10%, like that's crazy, right? But the reality of it is if you, and it's interest only, that's the other thing we need to look at. So if you only borrow $5,000, then your payment is going to be very reasonable, because an interest only payment on $5,000 at 10%, you're not going to even really recognize that. And the difference between 10% and 8% or 6%, it's going to be very minimal.
Yeah, and keep in mind, right, that you are only required to pay interest only, right? You can pay principal. It is a variable rate. So the Federal Reserve has continued to raise rates, right? So we are at a high point in terms of interest rates on line of credits, where we can see that come down. Now, there are limitations how much it can go up or down year over year. So it's important to kind of be aware of those, because you want to be prepared if that rate goes up as well as goes down. In terms of budget. But it's important to note, how does the rest of that line of credit work, right? We talk about this 10-year draw period, but it is a 30-year mortgage. So at the end of that 10-year period, it now becomes the repayment period, meaning whatever balance is remaining after year 10, you now pay principal and interest on that amount remaining over the remaining 20 years to pay it off. So that's where we tell people that first 10 years is interest only, where you're only required to do that. But it's always good, right, to be making additional payments, because you don't want to be unprepared for what that payment becomes in year 11, which we actually account for when it goes to qualifying purposes. We calculate based off of what that payment will be in year 11, because we want you to be financially prepared to handle that payment as well.
Well, and I think, and I've done these for a long time. This equity loan has always been popular when interest rates were in the high twos on a 30-year fixed. They weren't that popular. But what I've always done on these is, you get to that 7-year period, that 8-year period, hey, you feel like you're going to still carry a balance on this. The interest rate's going to go up when it goes to a fixed payment. Your payment's going to go up to amortize it over that last 20 years. We just refinance that equity line of credit and start that 10-year clock over. So that's just another strategy that we can look at. So, and I really like this equity line of credit for someone that maybe gets bonuses, or someone that, where they can really like borrow against this loan, and then they can really put some large principal reductions on this payment, because like Mike touched on it, the minimum payment during the first 10 years is only that interest only. That's the minimum. You can pay anything that you want above that, and it goes directly to principal.
Yeah. So at the end of the day, it is a resource depending on your needs and how to best utilize your house. Because again, that home equity is there, but if we are misusing it or not using it at all, right, it doesn't serve a lot of opportunity to you. So it's really best to kind of go through this and do an analysis to figure out, okay, how do we best structure this for you specifically?
Yeah, and as we're finishing this off too, I think that we should really make this point too, that hey, this home values are going up, that you have more equity in the property. This equity line of credit, it's not meant for your home to become an ATM. That's not what we're talking about here. So we have to be financially responsible to help you and advise you through this, to make sure that what you're doing, this isn't meant for you to do this equity line of credit and go out and buy a new boat or buy a motorhome. Like that's
I specifically just told that to someone, to be honest with you. I said, hey, it's not to go buy a boat. I mean, ultimately that's your choice, but that is not what our recommendation is here. And I think that's where kind of the stereotype of line of credits from 2007, 2008, right? Yeah. It's not built that way, and we're definitely not advising that way, because you can't access 100% of your home's equity. And we really want to make sure that we're improving your overall financial situation, not just leveraging and taking on more debt by using your home's equity.
Yeah, and that ATM analogy comes from that time, and it still kind of has that stigma, I think. But this can be a real tool to for financial wealth if you use it correctly and use it properly. And we're here to help you, walk through that together.
Yeah. So
great. So here we are. Here's equity. This is a great topic. So if you have further questions, make sure you reach out to myself or Mike. We're here for you. Thanks for listening. Thanks for joining us again. And we'll see you on the next one.
See you next time.